With trading week, market participants are looking forward to the long-awaited event. On Wednesday, traders will finally find out whether the US Central Bank will cut interest rates. After Friday's non-farm payrolls, that forecast is no longer as clear as it used to be. The statistics look very dubiously. Remarkably, the US Department of Labor reported a decrease in the unemployment rate. The jobless rate looked a downtick from 4.3% in July to 4.2% in August. Curiously, employment has grown at such a rate in recent months that the unemployment was supposed to rise. This is exactly what happened in a few recent months in a row. Importantly, given the population size of the United States, its growth rate as well as the age composition, employment in the US should grow by more than 200,000 per month in order to simply maintain stability in the unemployment rate. But over the past 12 months, it has grown by an average of 143,000 per month. The US Department of Labor provides similar data. It publishes data on the number of new jobs created outside of the farm sector. Essentially, this indicator shows the limits by how much employment can increase. According to the latest non-farm payrolls, 142,000 jobs were added in August. In a total, over the same previous 12 months, an average of 196,000 jobs were created per month. And this is clearly not enough, even if we assume that the employment data is not entirely accurate. The new jobs themselves are still not enough to ensure the stability of the labor market. With such indicators, unemployment is expected to go up, and this is what was observed in the previous months. But now, in some incomparative way, it was decreased. Nevertheless, despite the obvious inconsistencies and extremely unpleasant glaring issues, the US dollar was even able to somewhat strengthen its position. The US dollar index, which shows the dollar's position against a basket of 6 major currencies, is regaining its footing, rising 201.5 points. But given the election race in the full swing and the fact that the bulk of the American media is clearly supporting the Democrats, the mainstream media will point to the fallen unemployment rate. This is viewed as an argument in favor of Kamala Harris. So any oddities with the labor market data will be immediately neglected, at least in the information space. To sum up, falling unemployment is bullish for the US dollar. Just last week, the euro-dollar pair traded with the higher volatility, and the main factor determining speculative activity was the economic calendar, in particular the official non-farm payrolls. As a result, the euro-dollar pair first spiked above 1.1150 and then slipped to 1.1100. Taking into account the initial speculative cycle, technical analysts do not rule out a movement towards the upper border of the psychological area of 1.1000 and 1.1050, which currently serves as a support for the euro sellers and a signal for increased dollar buying. However, we are mindful of fundamental data and the news flow, which can lead to rapid changes in the direction of the instrument. In the oil market, traders are absorbing the news that OPEC and its allies have decided to postpone the planned increase in oil production. In this context, the price of the BRENT benchmark rate continued its decline and almost reached the key psychological level of $70 per barrel. Despite the persistent technical signal that the asset is oversold, inertia continues to dominate the market. If Brent does complete a full pullback, there is a possibility of touching and even breaking through 70, which could escalate overheating short positions. Experts are confident that crude oil is trading under speculative pressure. Moreover, the main argument is still the upcoming increase in oil output rates. Although it's obvious that the OPEC statement was made precisely to prop up the oil market. Most likely, the largest oil exporters will eventually decide to abandon the idea of pumping up production rates. After this, the market will begin to stabilize and prices will recover. What's wrong with the ruble? After fairly rapid and even sudden strengthening, the dollar-ruble pair returned to the level of 91. At the same time, there were no significant reasons for either strengthening or weakening of the ruble, so the market simply returns to where the instrument traded before. Most likely, the market will consolidate in the range of 90 to 92 rubles per dollar. So that's all for today. We continue to follow developments in the financial markets. Subscribe to the channel and follow changes in market sentiment with us. We wish you profitable trading and see you soon!